The salesperson slides a paper across the desk. $377 a month. Looks affordable, right? Here's what they don't tell you. Drive that car for 4 years, and you'll pay almost $27,000 for a car you never actually own. That's the trap. Most people look at the monthly payment. They think it's affordable, they sign. But the monthly payment is not the real number. It's not even close. In this video, we're covering all 5 ways to pay for a car, what each one really costs, which one comes out cheapest, and there's one option almost no dealership will bring up because there's nothing in it for them. Stick around. By the end, you'll know exactly what number to look at before you sign anything. This is Money Clarity, where we break down money without the jargon and without the fluff. Just clear numbers so you can make a smarter call. Quick note before we start. This video is for general information. It's not personal financial advice. Your credit score, your lender, and your local rates will change your numbers. Always check with your own bank or lender before you decide. Now let's get into it. Setting up the comparison. To keep this fair, we're using the same car across every option, a brand new Audi A3. Purchase price, $35,000. We're assuming a good credit score, around 720, and a loan interest rate of 6%, which is close to average for someone with strong credit today. We're also assuming a 4-year ownership period. These numbers are close to what a real buyer with good credit would see right now. Your actual rate might be higher or lower. It depends on your lender and your credit history. If your credit score is lower, expect a higher rate, and every number in this video will shift a bit in the other direction. One more thing before we start. We're keeping this simple on purpose. We're not including things like insurance, registration, or maintenance costs, since those stay roughly the same no matter which option you pick. This is purely about the cost of the money, not the cost of owning a car in general. There are 5 ways to pay for this car. Before we look at the numbers, you need to understand how each one works. The 5 options. Option 1. Auto loan. An auto loan is basically a car mortgage. You put down a deposit up front, usually 10 to 20%. Then you pay off the rest over several years with fixed monthly payments. Once you make the final payment, the car is fully yours. The catch is interest. You're borrowing money, so you pay more than the car's sticker price over time. But at the end, you own something real. Every payment builds toward that. Option 2. PCP, or Personal Contract Purchase. This one confuses a lot of people. Pay attention here. With PCP, you're not paying off the whole car. You're only paying for the value the car is expected to lose while you have it. You put down a deposit, you make monthly payments, and right at the start, the lender tells you what the car will be worth at the end of the deal. That's called the balloon payment, or the residual value. Because you're only covering the drop in value, your monthly payments are lower. At the end of the term, you get 3 choices. Pay the balloon amount and keep the car, hand the car back and walk away, no extra cost. Or if the car is worth more than the balloon amount, trade it in and use that extra value toward your next car. Sounds flexible. It is. But a lower monthly payment does not mean a cheaper deal. We'll prove that with real numbers in a minute. Option 3. Leasing. Leasing is the simplest to understand. You're renting the car. That's really it. There's no deposit in the usual sense. Instead, you pay an initial payment up front, usually equal to about 3 months of payments. After that, you make monthly payments until the lease ends. Then you hand the keys back. No balloon payment, no ownership decision, nothing left to pay. It's a good fit if you want a new car every few years, and you don't want to deal with repairs or selling a used car later. But there's a trade-off, and it's a big one. We'll get to it. Option 4. Personal loan. This is the one almost no dealership will mention. And the reason is simple. There's nothing in it for them. A personal loan comes from a bank or a lender, completely separate from the dealership. You take the loan, buy the car outright, and own it from day one. Then you pay the bank back over time, with interest. Personal loan rates are often lower than dealer financing. Not always, but often enough to check. Here's why that matters. Dealerships make money when you finance through them. A personal loan cuts them out of that profit completely. That's exactly why they rarely bring it up. Always check this option before you sign anything at the dealership. A quick tip here. Get pre-approved for a personal loan before you even walk into the dealership. That way, you already know your rate, and you can compare it against whatever the dealership offers you on the spot. Sometimes the dealership rate wins, especially during a promotional period. But you'll never know unless you check both. Option 5. Buy outright. This is the simplest option of all. You have the cash, you pay the full price, and you own the car immediately. No monthly payments, no interest, no agreements to track. Does that automatically make it the best choice? Not necessarily. We'll get to that too. Now, let's look at the numbers that actually matter. This is the number every dealership loves to talk about. Here's what you'd pay each month for that $35,000 Audi under each option. Auto loan. Put down $3,500, and your monthly payment lands around $791. PCP. Same $3,500 deposit, but since you're only paying for the drop in value, your payment drops to around $545 a month. Leasing. Your upfront payment is about $1,130. After that, your monthly payment is just $377. Buy outright, no monthly payment at all. You pay the full $35,000 on day one. If monthly payment is all you look at, leasing wins by a mile. $377 sounds incredible next to $791. But monthly payment only tells you what leaves your account each month. It tells you nothing about what the car actually costs you over time. This is where most people get it wrong. Let's fast forward 4 years and add up what you've actually spent. Auto loan. Total cash paid comes to around $41,500. PCP. If you pay that final balloon payment to keep the car, your total comes to around $43,815. Leasing. $18,830 over the full 4 years. Buy outright $35,000 spent on day one. So leasing still looks like the winner here. Not so fast. This still isn't the full picture. Layer 3. The real number. Here's what changes everything. With an auto loan, PCP, or buying outright, you own the car after 4 years. Based on average depreciation, that Audi could still be worth around $17,000. That means you can sell it and get a big chunk of your money back. With leasing, you can't do that. You hand the keys back. You never own the car. There's nothing to sell. So the number that actually matters isn't what you paid out. It's what the car truly cost you, after you account for what you get back. Let's subtract that $17,000 resale value and see the real cost. Buy outright, net 4-year cost, around $17,850. Leasing, around $18,837. Auto loan, around $24,318. PCP, around $26,665. Look at that again. The option with the lowest monthly payment, leasing, is actually the second most expensive option overall. And PCP, which felt cheap and flexible with its low monthly cost, turns out to be the most expensive option on the list. The full picture flips once you use the right number. What about opportunity cost? Buying outright wins on paper, but there's one more thing worth thinking through: opportunity cost. When you pay $35,000 up front, that money is locked into the car. It's not doing anything else for you. What if, instead, you put down a small deposit, financed the rest, and invested the leftover cash in something like a low-cost index fund? If your investment returns beat the interest you're paying on the loan, financing can actually come out ahead. That gap is called arbitrage. Your money earns more than it costs you. Here's the honest part, though. The interest on your loan is fixed. You know exactly what it costs every month. The stock market is not fixed. Returns move around, especially in the short term, so this isn't a clean, guaranteed trade. You're weighing a fixed cost against a return that isn't promised. There's a second issue too. In theory, you invest the leftover money and leave it alone for years. In real life, for most people, that money slowly gets spent on other things instead. A vacation here, a home repair there, and suddenly the money that was supposed to grow for 4 years never even made it into the account. This isn't a knock on anyone. It's just how most people actually behave with spare cash sitting around. Plans on paper and habits in real life are two very different things. So here's the honest takeaway. If you're disciplined with investing, and you actually leave that money untouched, financing plus investing can beat buying outright. If you're not sure you'll stick with it, buying outright is the safer, simpler path. There's no wrong answer here. Just be honest with yourself about which type of person you are. 3 questions. Before you decide now, you've seen the numbers. But personal finance is personal. The cheapest option on paper isn't automatically the right one for you. Ask yourself these 3 questions before you decide how to pay for a car. Question 1. Are you focused on the right number? Walk into any dealership, and everything is built around the monthly payment. That's on purpose. A smaller number makes an expensive car feel affordable. Here's how that trick works in real life. Say your budget is $25,000. The salesperson nudges you toward a $35,000 car instead. As a lump sum, that gap feels huge. You'd probably say no right away. But framed as just $8 more a month, it suddenly feels like nothing. That's the trap. Always look at total cost and net cost, not just the monthly number. Question 2. How much does driving a new car actually matter to you? Be honest with yourself here. For some people, driving something new genuinely adds value. Better safety features, a manufacturer warranty, lower repair costs, and the simple enjoyment of a new car. That's a real benefit, and it's fine to want it. Just choose it on purpose, not because a salesperson talked you into it. But if you're someone who keeps a car for 8 or 10 years, buying almost always wins. You're spreading that upfront cost over a much longer time. Think about it this way. A car loses most of its value in the first few years. If you lease or finance and trade in every 3 years, you're paying for that steep drop again and again. But if you hold on to a car for a decade, you only pay for that steep drop once, and then you get years of nearly free driving after the loan is paid off. Question 3. How does this fit your overall financial picture? A car is one of the biggest purchases most people make. It doesn't exist on its own. Before you commit, think about the full picture. Does the payment still leave room for rent or mortgage, for bills, for savings and investing? Does it still leave room to enjoy your life? A car that stretches your budget too thin isn't a good deal, no matter how small the monthly number looks. On the flip side, maybe you can comfortably afford more than you planned, and you're happy to spend a bit more here and less somewhere else. That's a valid choice too, as long as you make it with the full picture in front of you. A simple test that works well here. Add up your car payment, your insurance, and your gas or charging costs. That total shouldn't take up more than about 15 to 20% of your take-home pay. If it does, it's worth looking at a cheaper car, a longer loan term, or waiting a bit longer to buy. 4 questions before you sign. Before you sign any finance agreement, run through these 4 questions. 1. How long are you realistically keeping this car? Under 3 years, leasing might make sense. 5 years or more, buying starts to look much better. 2. Are you prioritizing a lower monthly payment or a lower total cost? These are not the same thing, and you need to know which one matters more to you right now. 3. How much do newer features, warranty coverage, and convenience actually matter to you? If they matter a lot, factor that in. If they don't pay extra for them. 4. Will this decision still let you build toward your other financial goals? Emergency fund, investing, savings, travel, whatever matters to you. A car should fit into your life. It shouldn't take it over. Bringing it all together. There are 5 ways to pay for a car: auto loan, PCP, leasing, personal loan, and buying outright. The monthly payment only tells you what leaves your account each month. It tells you nothing about what the car actually costs you. The real number is your net cost over the full ownership period, after you account for what you get back when you sell. Based on that real number, buying outright wins, with a net 4-year cost around $17,850. Leasing comes second at $18,837. The auto loan sits at $24,318, and PCP is the most expensive at $26,665. But buying outright only wins if you have the cash ready and if that money isn't better used somewhere else. Always check the personal loan option too. Banks often beat dealer financing, and dealerships won't bring that up on their own. Before you sign anything, run through those 4 questions. How long you're keeping it, total cost versus monthly cost, whether the features are worth it to you, and whether it still fits your bigger goals. Most people leave a dealership having made a $30,000 decision based on one number on one piece of paper. That's a huge decision to get wrong, and it happens every single day in every single dealership. Now, you don't have to be one of them. You've got the real numbers. You know which questions to ask, and you know exactly which option almost nobody talks about. If this helped, share it with someone who's about to buy a car. It's exactly the kind of thing people need to see before they walk through that dealership door. Just plug in your own numbers, and it'll show you the real cost, not just the monthly one. See you in the next video.